So a year ago, in fact, just about this time last year, many of the economists and analysts were predicting that 2023 was going to see somewhere between a 10 and 30% drop in property prices. Yet here we are at the beginning of 2024, and we haven't seen quite those drops. So in this video, what I want to do is go through 10 of the main reasons why the property market did not crash in 2023. And at the end, we're going to have a very small chat or quick chat about what's going to happen in 2024. But before I go on and talk about these 10 reasons, I just want to make a comment, and that is that as human beings, we tend to internalize our belief systems. So when we are out there watching stuff on social media or mainstream media or YouTube, we are generally attracted to things that we believe, okay, or the narratives that fit into the internal belief system that we have. And when we have internalized a belief system, it's actually very difficult to change that belief system. We have to usually see very concrete evidence of why we need to change our belief system. And this is really interesting because when narratives start to change, we start to see a lot of conflict because that internalized belief system is then challenged, okay? And people are going, wait a minute, what's going on? Something isn't right here because I've been believing or had this value system or this belief system that property prices are going to crash in 2023. And then when that's not happening, a couple of things will happen. Number one, when we start to see information or narratives that contravene or conflict with our belief system, it starts to create conflict, okay? And it manifests very often by, sort of arguments and polarization and all this sort of stuff. So interestingly, I did a video last week, the last live that I did, which I titled, slightly tongue-in-cheek, "Property Prices to Surge." I can't remember exactly what it said. There's a lot of people came on to that in terms of the comments and were like, how could you be talking about this? Property prices are going to surge. All of the HPIs, house price indices, are a load of BS, right? This is a disgrace. And I think that's a really interesting observation, that we're starting to see this conflict happening with the belief systems that are being challenged. Now, even if we see a belief system challenged with empirical evidence that there can be no doubt, when we see data that says there's no doubt that the belief system is now wrong, we then have one of two things happen. Number one, you change your belief system, or the second is that your belief system is so internalized and it's so intrinsic to you that you will reject the empirical data that you see. I'm talking you generically. And this is where we start to look at conspiracy theories and all of this sort of stuff. And I'm seeing a lot on lots of threads at the moment with people saying, look, all these HPIs, house price indices, they're all a load of bollocks, right? They're all selective. It's the banks lying to us. It's the system is lying to us to lull us into a false sense of security or whatever. Yet when the prices are coming down, when the HPIs are coming down, nobody there is saying that it's selective and BS. But the moment they start showing something going up, then all of a sudden it's all complete manipulation. Now, I would like to draw a line under this and say my view on this. I am not saying that we are now in property prices going up. I'm not saying we're going to have a meltdown in 2024. I'm saying, as I've always done on this channel, and this is my core vision for the channel, is to make sure we stay on top of the data as it comes out and analyze it and try and draw our own rational conclusions from the data that we're looking at. And if that means, right, that something has changed and we've seen a pivot point or an inflection point, or, the trends have changed, we have to be able to analyze that and come up with a rational, sort of conclusion of why it is, rather than just saying it's changed, therefore it's bullshit, because that does not serve anybody. So all I'm saying is let's look at everything that's going on. Let's analyze what's going on. Let's try and make sense of it. Now, I can see we are live. Sorry, that's a little bit of an intro rant. We are obviously live, so if you can see me and hear me, please give me a thumbs up, and please find something in the comments and put something in the comments to say that it's all working all right. For those of you who are new to the channel, a big welcome to you. In these live streams, we look at data and try and understand what's actually going on and make sense of the market. And one request for you, because you know what my aim is if you're a returning viewer in 2024, is to grow this channel to be able to give as much objective data analysis to enable us to make better decisions as investors, as business owners, as homeowners, right? Rather than fall for the mainstream and the social sphere narratives. Because I think I've always said this, That's gone a little bit crazy. I need to work out to turn this thing off. Sorry, it's something to do with the Apple algorithm. Creates all these fireworks and stuff. Something that I've always said is we have to be objective. My vision is to help people make those decisions, and we can only make those decisions if we question and then come to our conclusions. So what we'll do is I'll go through these 10 points of why I believe the property market hasn't crashed in 2023, and then we'll go to Q&A and have a chat about them, okay? And then I'll summarize at the end before we go to that Q&A actually. But feel free to play along as we go through. If you see something I'm talking about and you don't agree with it and want to challenge it, okay? If you agree with what I'm talking about, put why you agree about what we're talking about. But these are, for me, the 10 reasons that the property market did not crash in 2023. Let's dive into it, team. All right, so the first one of these is the amount of fixed rate debt and lag in the system. So we talk about this pretty much every time I go live. I talk about the gap. That's the amount of people, okay, that are still coming off fixed rate mortgages and the amount of time this takes to filter through. Oh, and by the way, just another caveat. Today, I am not talking about what's going on with swap rates and mortgage rates. I'm well aware that swap rates are coming down, mortgage rates are coming down. I'm well aware that people are calling Bank of England for interest rate cuts. We're not talking about 2024. I want to look at the last 12 months and analyze that. All right. So the amount of fixed rate debt, the amount of people who are on sub 2%, 2.5% mortgages, and how many of them are coming off. Let's back all of this up with some data. We're going to go super data heavy right today, and I want to analyze this. This is a graph of starting Q1 2022 over here. The amount of people coming off fixed rate is the red, if you like, and you can see. And this is, by the way, just to tell you exactly what the reference is. From Q1, since Q1 to Q4 2021. Okay, so basically since 2021, how many people are coming off fixed rate deals? And we can see where we are now is just here. We're in Q1 2024, right? So even now in Q1 2024, we've got 5.3 million people here that have come off fixed rate deals since 2021. We're still only 2/3 of the way through. How many people are going to be there by the end of 2027? Still only 2/3 of the way through. And if we look at this, okay, we've got a load of people here, 2.1 mil, 2.5 mil, 2.8 mil, that are coming off in 2022, which was still right at the beginning of the rate tightening cycle. So a lot of these people who've come off, been in fixed rate debt that's come off since 2021, right into 2022, could well have fixed on to still relatively low mortgage rates compared to what we're seeing now. So that, when we actually look at the amount of people that have come off cheap fixed rate debt and had to refinance onto expensive ones, it's still quite a small percentage of the UK householders, all right? So it's not like everybody is suddenly having mortgage rates triple all at once. And yes, we log into the mainstream media and every day they like to parade somebody else who says, my mortgage has gone from £200 to £2,421 overnight. It's a nightmare. I can't afford it. This is not everybody. So we have to look at the data set, the amount of people that are actually doing it. However, what we can see is this continues. So during 2024, we're going to have another 1.4 million people come off the cheap debt. 2025, we're going to have more people, and it does start to slow down. You can see it starts to slow down. So we've still got more people coming off over the next however many months and actually years. Okay, so that's the first reason: the amount of people on fixed rate debt and the lag that puts into the system. Now, factor number two, or point number two, is people lengthening their mortgage terms. Let's just, before we go and look at the data on this, let's just explain how house prices, kind of really work. It's nothing to do with inherent value. Of course, there is an inherent value, but ultimately, houses or homes or property in this country are worth what people can afford, what they can pay for them. If people can afford more, if they can borrow more, the prices will go up. If they can borrow less, in theory, the prices will come down. So there are multiple ways to actually change your affordability. One of the big narratives that went through in 2023 is the affordability issue with the interest rates going up. Of course, as interest goes up, if you're on a variable, if you're refinancing, your mortgage is going to go up, and therefore you're paying more for the same amount of debt, so you can afford less ultimately when you refinance. Unless you do a couple of these things. One of them is lengthening your mortgage terms, okay? And if we come back to the data and we have a look at this here, Sorry, I can't really zoom in on that much more. But this is a graph of people who are going on to, percentage of people who are going on to, I think it's 20, it's 30, a term of 30 years or more, okay? So look at this. Half of all first-time buyers in the UK and over a quarter of home movers who took out a mortgage in the third quarter of this year, this is last year obviously, opted for a term of more than 30 years. Half, that is incredible. Half of first-time buyers are now on mortgages that are 30 years or more. So because you're stretching out the repayment terms of that debt, it means your monthly payments are going to be less, which means you can afford to borrow more, okay? So this, of course, is another way of increasing your affordability. I'm actually gonna demonstrate this in a second with some data analysis that I crunched, okay? So I don't want to talk today about what I believe is a massive ticking time bomb that this is going to put into us as a nation and, you know, our pensions, all that sort of stuff, 20, 30, 40 years down the line. Of course, it follows that if you've got longer mortgage terms, people are taking the longer mortgage terms to be able to afford more with the idea that they'll repay it early. Okay, and that's the justification. It's like, you know, I'll overpay or I'll get, you know, a better job and I'll pay it off early. The problem is that never or very rarely happens, because when we're on that debt, we're just going to keep it. Because if we get pay rises, we're going to spend it on other stuff, right? Consumer stuff that makes us poor. That's a conversation for another day. So number 2, lengthening of mortgage terms. Number 3, strong nominal wage growth. Now, I say nominal because, yes, I'm fully aware that for most of 2023 and some of 2022, we were actually on a negative real-term wage growth, i.e. real-term wage growth was less than inflation, or wage growth, inflation adjusted, was negative. However, that's vaguely irrelevant in the context of this because nominal wage growth was very strong. Yes, we were getting poorer in terms of inflation adjusted wages. But of course, when we're looking at house prices, all the indices are looking at nominal house prices. So you have to associate nominal house prices with nominal wages. We'll talk about real house prices at the end, or we'll talk about it very briefly at the end. So when we look at nominal wage growth, and I'm just going to try and find the right slide, and I'll go onto it here. If we look at nominal wage growth, we can see that it's been up at, I mean, blimey, that's COVID. It was up at 8.9% over here. In July 23, 8.5%. So total pay, nominal total pay, 8.5%. We've had strong wage growth. And this is, of course, put a soft cushion in for the affordability of people. So nominal wages go up, people can afford to borrow more, okay? And what I want to do is I'm going to show you this, okay? I very, very briefly put this together before I came on the live, just to have a little look, and I'll show you that at the bottom. Right, so up here, I took these stats from an article that showed what you could afford based on mortgage payments at a 2.5% interest rate mortgage and a 5% interest rate mortgage based on a 25-year mortgage, okay? So if you could afford £1,000 a month payments on a 2.5% mortgage, right, you could afford 2.5% interest rate, you can afford a £221,000 mortgage, 5%, 169,000. So this was an article that was actually saying how interest rates changing from 2.5% to 5% is reducing the amount that people can borrow. If they are making they can only make the same monthly repayments. And therefore, if you can borrow less, of course, you can buy less of a house or the value of a house. And therefore, in theory, house prices come down. Okay, so this follows through. Now, what I did with this, and you might say it's a load of rubbish, right? It's a very quick thing to illustrate a point. I Googled how much of our average net pay do people spend on their mortgages? And the answer was approximately 35%, okay? So if we're spending, let's just use this column here. If we're spending £1,000 a month on a mortgage, and that's 35% of our net pay is £2,857, which is £34,000 annual. And I put this into the PAYE take-home calculator, reversed it. That would be an annual gross of £43,587 worth of gross salary. Now, let's assume just 1 year of wage growth at 8.5%. That takes our wages, nominal wages, from 43,500 to 47,291 with 8.5% growth. Now, if we net that out, this is post-tax. So again, this is going through a PAYE calculator to give us an accurate take-home. it's going to net out at 36,000, which is £3,029 per month, which is an increase of £172 per month. Okay, disposable income. Now, I know you're going to say this model doesn't assume that you're going to spend it on anything else. True. But if you were just to take that wage increase, that take-home wage increase, and then put it onto your mortgage payments, okay? So disregarding cost of living, disregarding food, all that sort of stuff, I get it, right? There's way more other complex factors here. I just want to illustrate the point. You can now afford £1,172 per month. Okay, so you could afford £1,000 per month in your mortgage payments. This is capital repayment, by the way. You can now afford £1,172. What I then did is modeled that on a 5% interest rate. So remember, they've modeled it up here on a 5% interest rate, but I've also modeled it on a 40-year repayment term. Okay, and with that disposable income you can spend on a mortgage, 40-year, 5%, we can now borrow $240,000 on our mortgage, which, if we scroll up here, is more than we were borrowing on a 2.5% 25-year mortgage. Okay, so I think that just demonstrates the principle. I ran it through, by the way, these cells just to prove. So, you know, if you're spending £2,000 a month on your mortgage, you know, at 40-year 5% interest rate, you can now achieve 40, or you can now borrow 470,000, which is, you know, 30 grand more than the 25-year term at 2.5%. I didn't do the last column, so I got a little bit bored. But the principle is here. If you have nominal wage growth and if you extend out your mortgage terms, you can still afford what you could afford previously on a 2.5% interest rate. And that is another reason that has softened the blow with the house prices. By the way, keep the comments coming. I'll come back to them afterwards. I hope this makes sense. Give me a thumbs up if you think this is logical, reasonable, and a relevant explanation as to why we have not completely crashed over the last year. Okay. We've only done 3. We've got another 7 to go. And I know how complex this whole system is, right? No analyst or bank or economist knows what's going on because there's so many moving parts and so many macro factors here. All we can do is look at these big picture principles. So next one, liquidity in savings post-COVID. This is a really interesting one. And I think this is going to be controversial. I think some people are going to disagree with me here. Something that even I was talking about 6 months ago is the amount of net outflow from savings accounts that we were seeing. And a lot of it was put down to cost of living crisis, for people's affordability getting crunched and having to withdraw savings and liquidity to keep paying for stuff. And of course, that then gives the narrative that if people are having to withdraw the savings, they're really struggling. But I'm going to question that now. So I've not seen a graph for a while because I grabbed the graph where we saw a big net outflow. I think it was sort of, I can't remember if it was summer last year, from savings accounts, which the BBC flashed on. And this, by the way, and I know I was using a mainstream media source, it came from, I believe it came from the ONS, which was the source credit, why we have to understand what's actually happening. Because that outflow is just an outflow of savings accounts. It doesn't say where it's going. For example, could that outflow be from general savings accounts into high yielding, longer term fixed rate bonds, for example, or other investments? Maybe people are taking their money out and putting it into taking their cash and buying property cheap, right? We don't know where that money's going. It's just coming out of a savings account. So we have to question everything. What we do see when we look at data is if we look at the UK household saving ratio, okay, this is a Office ONS published statistic. We can see the graph here that gives us, I want to see if it gives us the long term. Right, so the average from 1955 until 2023 is 8.51%. And just to explain what this graph is, this is the ratio of post-tax income that the average person in the UK puts into savings, okay? And of course, this is going to be skewed by higher earners versus lower earners. And we do not have the time to start breaking this down into demographic bands, right? This would take months to crunch all this data. I'm just giving you overview here. We can see that when we went into COVID, there was obviously a massive spike up in the savings ratio because everybody was locked away for the best part of a year. Everybody was given a load of free money for not working and we couldn't spend it, right? So it all went into the savings accounts. We then came down. But if we look at it from 22 to now, we're trending up. This graph is trending up. And if we compare it to pre-COVID, right, pre-COVID, the savings rate from sort of 2017 to 2020 was meaning around 5%. We're now, right now, at 10, what is that, 10 point something percent? 10.3% we are. So the actual savings, household savings ratio is increasing, which shows people are saving more money right now. Now, again, unless these stats are complete BS and manipulated by the ONS, okay, people are putting money away, which again supports the narrative that actually we're not in a horrific cost of living crisis. By the way, again, just to clarify, I'm talking generically across the UK. Of course, this is going to be skewed. There are going to be subsets, the lower income demographics are the ones that are going to really be hit by the cost of living crisis. The middle classes, depending on how much mortgage they have, depending on what they probably have some ability to cut back. The rich are going to be getting massively richer because all of that money that came out through COVID will be invested. I know because, I did it, right? I put money into investments, properties. That's all creating equity, it's creating income. And then a lot of people who just have cash are just sticking it in savings accounts right now and getting a great interest rate on it. So of those, if we go back and look at, let's look at this. So we're literally right now, we're talking 5 to 5.3 million people, who've had a fixed rate mortgage disappear and have to refix since all this started. Think about how many people have no mortgage in the UK and have chunks of savings that haven't been getting anything from it for how many years. And they're now getting 4, 5, 6% in savings accounts. NS&I, what was it, a 6.3, 6.4% bond that was offered a few months ago, which huge amounts of people took them up on that. So these are all now creating a lot of extra liquidity and income into the system. And this money doesn't just disappear, okay? So that liquidity in savings post-COVID is effectively now available to go into assets, right? It can go into, imagine Bank of Mum and Dad who have a load of liquidity and are now getting much better rates on the savings, and they've got strong nominal wage growth, and they're putting more away, and they can lend their, sons, daughters, relatives, families money for deposits. If you have a bigger deposit, your affordability again for the mortgage goes, changes because you don't need as big a mortgage. So you can have smaller mortgage, bigger deposit, buy more of a house. So this again is cushioning the blow. So liquidity and savings post-COVID. Okay, so that's kind of people's personal finances. We're now going to look at some other things. So rather than just the personal financing. So let's start with lower transaction volumes. This again is one that we've been talking about for a huge amount of the last sort of 3 months, that we've been talking about the property market going into massive sort of paralysis and massive freeze, and the transaction volumes have been so low. If we go and look at the data again, we can see this is mortgage lending rather than transaction volumes. I think it's easier to see mortgage lending. Yes, we have had a little uptick, but we're still well below, still here. We're only being trumped by COVID, mini budget not last year now, year before last, and financial crisis of 2008 as to the sort of transaction volume of mortgages being approved. So this is supply demand. That lower transaction volume, that lower mortgage approval volume means less are being done. So supply demand balance is completely out of skew at the moment, right? People aren't selling, people aren't buying. People are sitting on the hands, and they're sitting on the hands because they can, because there's a lack of forced sellers. We'll get to that in a little bit. Why would somebody be selling their house on their nice, cheap, fixed rate debt mortgage if they don't have to, right? They can just sit there and ride it out until the interest rates, hopefully, maybe, come down again. So transaction volumes is freezing the market and again, stopping it from crashing. I've said since I started this channel that one of the key things that will cause the market to crash 20% plus is a flood of motivated sellers, a flood of forced sales, and we have not seen it, okay? So that is reason number 5. Now, I do apologise. I couldn't work out on Keynote how to get them to start numbering from 6. So we're going to have to start from 1 again. So from 1, this is just a very quick one. Forbearance. Effectively, this is banks agreeing with the government not to start repossessions for 12 months after they could do if people fall into arrears. Again, this is not solving the issue, but it's kicking the can down the road and giving people more chance and breathing space to try and solve any liquidity problems or inability to service their debt. If we have a look at UK repossessions data, let's just head over here. Let me zoom in on this one. I can zoom in on this one. I'm going to ignore the buy-to-let sector at the moment. I just want to look at the residential. So This is the data as to the end of Q3 23. It won't be long, probably 2 or 3 weeks until we see the data for Q4. Of course, we have seen an increase in arrears. And don't forget this teal line that's going up. This is the increase in the band 2.5 to 5% in arrears. Now, as I always say when I look at this chart, if you have a 75% mortgage that you've just taken out, to get in 2.5% arrears, you have to have missed 5.5 payments, 5.5 monthly payments, okay? So there's so much lag in this. Because for a start, let's say somebody, comes off their fixed rate mortgage in, August 2023, and then they struggle and they just about pay it in September and October, and then they start missing it. You're not going to see that show up in the data until March, April 2024. So there's huge amounts of lag in this. But we can see, quarter on quarter, 10% up, year on year, 36% up, but it's still well below historical averages. So the arrears are going up. That's for sure, right? There can be no doubt that arrears are going up. They're still not massive. But if we look at this graph here, number of mortgage possessions, and let's look at the homeowners, we're actually seeing the trend of possessions of homeowners drop. And that is because of the forbearance, and the banks are leaving people alone and actually being vaguely flexible. And you can see these numbers are tiny, right? If you transfer it over here, you're talking like 600 a quarter. It's completely different to the thousands and thousands of people that are being repossessed in 2008. Okay, so forbearance, again, is stopping people becoming forced sellers because they just don't have to become forced sellers right now. So another factor that is propping everything up, forbearance. Cool. Now, the next one, number 7, strong rental market. So this is a fascinating one to me. I'm just going to try and, before I talk about it, get the right stat up on, here we go. So let's talk about strong rental market. There are big areas of the UK where it is still cheaper to buy at current interest rates. And when I say current interest rates, I mean where they were at the peak of the swap rates last year, last sort of summer. Still cheaper to buy with a mortgage than it is to rent. We've seen this massive scarcity of rental properties, and this is creating there's just a huge supply-demand imbalance in the rental sector. The PRS, private rental sector, is without a doubt broken right now. If you are a landlord and you know what you're doing, okay, and you have things structured correctly, it is. I have to be careful how I say this because I don't want it to come across as opportunistic, but it's just business at the end of the day. That if you own stuff and you've got it structured correctly and you're not being crucified by Section 24 and the high interest rates, and there's various models and mechanisms that I teach my clients that you can use to get around a lot of that sort of stuff and have much more different, very different investment models, then those rentals going up are really increasing the yields a lot at the moment. And we were seeing for quite a few years, rental yields just on a macro scale in the property investment world drop. They're now going up again quite quickly with the explosion of rental values. Now, this is not good news, by the way. I'm not saying this in that, woo, I'm a landlord. It's great to have all this extra rent coming through. It's nice to have it on the P&L, but I know on a systemic and a societal point of view, this is damaging, right? It's damaging to people who can't afford rent, people trying to get on the housing ladder, try and save. It's just increasing that gap between the rich and the poor, right? So on a societal level, I understand this is a bad thing to be in, and we have to solve this problem somehow. There are, by the way, lots of models we can use to improve this and solve this problem with sort of, higher density, build to rent, a lot of other things, and not taking all the rental markets off in, for sort of short-term lets, not selling it all off because the government is taxing the hell out of private landlords. Lots of reasons. I don't want to get into that now. However, what I do want to show you is this from Zoopla, where it shows this came out. Let me just see the date on this. This was, there you go, August. This was August's house price index. This red line, this red dotted line, below it, so in all these regions, West Midlands, East Midlands, wrong way around. Above it, Wales, Yorkshire and Humber, Northern Ireland, Northwest, Northeast, Scotland. So basically Midland, above the Midlands, it is cheaper to buy than it is to rent. So of course that is still fueling demand in certain house prices. And by the way, I am absolutely convinced that the way the HPIs work and the hedonic regression model and how this model is created, which is basically, it's almost like CPI model. It's like a basket of goods, if you like, or a basket of factors that go in for properties, and how these basket of factors sort of get, are being changed is going to direct how the average house price in the UK changes. So if, for example, you've got a lot of people going for smaller properties, which by definition in the areas, smaller properties have a higher price per square foot, that can skew the HPIs, it can skew parts of the hedonic regression model quite a lot. So anyway, the point is strong rental market is actually pushing people into buying. So it's cheaper for people to buy than it is necessarily to rent. So that's keeping some demand. By the way, I'm not sitting here saying this is going to make the property market surge. I'm just saying, well, it's not crashed 30% in the last year. Number 8, not number 3, number 8 is higher stress testing. Let's not forget what happened in 2008 when we went into total meltdown. And that's because in the run up to 2008, in the huge property boom from effectively mid 90s until 2007, 2008, we saw a lot of people able to self-certify on mortgages. We saw banks wanting to lend to anybody. There was very little in the way of stress testing going on. So of course, when it all started crumbling down, people couldn't afford. You had the ninja mortgages, no income, no job, the whole system came crumbling down. That was a very specific event that happened. And after that, the financial institutions took it on board and we changed the stress testing. So to demonstrate how the stress testing has changed, this is mortgage stress testing versus the actual rates. And we can see over the last sort of 10 years or so where the banks have been directed to stress test the rates to. So you can see when we got to sort of the end of 21, when the rates started to go up, well, in fact, before that, before we came to the end of 2021, we were still up at 7%, right? Stress testing. So this black line down here is what people were borrowing. Purple line is what the stress test. You can see the margin there. Now, as the interest rates came up quickly, you can, of course, see that that margin narrowed quite a lot, but still didn't reach it. And then the banks have continued to increase their stress testing, and I do believe that it's above 9% at the moment. And then we've had number 1 spike in swap rates, dip down after the mini budget, number 2 in the summer, and we're now dipping down again. We've got that margin re-established. Now, of course, because the stress testing is so high, this is automatically going to exclude a huge amount of people from the property market, which is another reason, and I don't think anybody's talking about this. This is another reason for me why why we've got such a crunch in property transactions, is a lot of people actually just don't qualify for mortgages, depending on their circumstances. It's not even just about income; it's income minus expenses. Everybody who applies for a mortgage has got to do their ALI, assets, liabilities, income, and expenses. And right now, a huge amount of people will not be qualifying under the current stress testing, which is another reason the market is in paralysis. So the only people who do have mortgages can absorb it. And actually, a lot of people who've got mortgages on a macro level are going to have that liquidity, all that sort of stuff. So I think that's a pretty obvious one that we do have the stress testing in there. Blimey, that's number 8. What about number 9? Geographical dislocation. It's an interesting one, and I haven't seen a huge amount of concrete data about it. However, the premise is this: we now live in a society where already we were going gig economy, right? So the ability to be much more remote and flexible in where we work, with the way of running businesses online, people could be more geographically dislocated from their place of work. Now, of course, when COVID came, that's accelerated that trend massively. With home working or hybrid working, people are able to now move away further from their place of work, or just be completely remote, and therefore, do not need to live in London with a company, working for a company HQ'd in London or the Southeast, and can, for example, move to the Midlands or move from the Midlands up north, and geographically relocate to areas where the value curve is more appropriate or better, right? So basically property are cheaper, so you can buy more property for your money. And with that sort of migration, we are seeing potentially, migration from south up to the Midlands and north, so a change of demographics, which is interesting to see how that sort of manifests over the next 10, 15, 20 years. That is another thing that's softening the blow. So we have some sort of anecdotal evidence here. And, oh no, I didn't find it. There was an article from Zoopla. I think I might have just run out of time to find it, the Zoopla one. Don't worry about it. I'll find it and I'll post it if anybody wants to see it. But there was a Zoopla one about this geographical. So I think they've got some data which shows a geographical, effectively dislocation or relocation, if you like. Wow, that's number 9. Final one are the regional skews. So let's actually talk about the HPIs now. So I know a lot of people have been very unhappy with the house price indices, right? A lot of people have been saying the data is fudged, it's selective, it's BS. And, my response to that is it might well be. The honest answer is I don't know, because I'm not going to sit here looking at thousands, if not tens of thousands of lines of data and actually work it all out. But something that I want to say before we look into the HPIs is HPIs are a model. I've said it once already this session. It's called a hedonic regression model. These models are not perfect, okay? These models have got limitations. And just because the model says house prices are going up or house prices are going down, it's very difficult to actually know what's going on the shop floor, because there's so many factors that go into this that can skew it. All of the HPI, so Halifax and Nationwide, have both said, when you see the narrative and read in between the lines, that because the transaction volumes are so low, these models are not actually working as they would usually work. So we do have to take everything with a pinch of salt in terms of what we look at with these models. I completely agree with that. What I don't agree with is just, people who have an internalization that property market's going to crash when they see the models go up, say it's all a load of bollocks, right? It's not that simple. So that's the first thing. It's understanding how these models actually work, okay? Second thing I want to talk about with the models, therefore, is the skews. So when we talk about the models, very often we're talking about an average. So this is the Nationwide. If you remember, Nationwide posted, I think it was a 1.2% overall drop in the UK housing market in 2023. If we look at the regions, we actually see a very different picture. So in some regions, East Anglia, you're seeing an almost 6% drop year on year. We have some skews. So Northern Ireland is skewed up, 4% rise. Scotland is skewed up. What I'm saying here is we need to understand our individual markets. We can't look at the UK housing market as a whole, because everything is going to have different, supply demand factors, different economic factors, so many things in the mix. And this is why data is so important. When I teach this to my clients in where we look for to invest, I use a concept called microscaping, which effectively is going to a granular level in any area, even to a street by street level, and understanding the market dynamics. Because in some places you'll have a road, and one side of the road you'll have completely different economic situation and housing market to the other side of the road. And we need to be able to understand that, because if we just use these big averages, right, we're going to get these vaguely or fairly irrelevant sort of figures that pop out. So, this is the Nationwide. We can see that's showing a very, very different skew. If I look at the Halifax don't really publish this, I don't think. They said something, I'm not going to be able to read this without my glasses. There was something somewhere about regionals, but you can see here on the Halifax, there is nothing here that shows the different regions. So I'll be interested to see Halifax. I'm sure it does break it down as to, the region by region. The other thing is, by the way, if I just zoom in on this, everybody gets caught up with the month on month. I would say, and I always say this, look at the trend, not the month on month. Here on the Halifax, we have broken a trend line and we are going up. That's why the thumbnail on my video last week said house prices boom, right? Not booming or house prices surging, but that is definitely a trend line. Of course, we have to challenge the data. Of course, we have to take it with a pinch of salt, because here's my belief. I do not make predictions, right? If anybody watches this channel regularly, my job here is not to say, oh, I predict in 2024, we're going to see a 30% drop or a 10% rise, okay? That's for the people who want to get eyes on to look at those predictions. Yes, I give my predictions in terms of what I think is going to happen on a trend basis. And my predictions on a trend basis for 2024 is we're still going to see nominal declines in 2024. I said it when I started the channel last year that 2023, 2024, we're going to see nominal declines. It's all interest rate dependent. And that's the only thing that is something I will hammer my reputation to, is that the future of the property market, and I'm going to do another video this week about this, is not entirely dependent, but the interest rates do have an effect on it. Now, we've talked about on this video why the interest rates rising has not automatically led to a massive crash. And I think I've gone through 10 fairly compelling reasons that have shown or demonstrated why property prices have not crashed in 2023. But I want to leave you with this thought, team. I want to leave you with this thought. Oh, no, I'm pressing the wrong button. Sorry, too many screens there. Has it actually crashed? That's the question that we have to ponder. And it all depends on your perspective, okay? Because there's the one graph that I always show that for me is the one that really matters as an investor. And it's this one. And I have actually seen the Q4 data is now out. I didn't have time to go and, because I didn't want to do cut and paste today. I just wanted to get some websites. I haven't found it on a website, but I did dig into Nation. In fact, no, I'm not going to do it. I dug into the nationwide reports and found the actual Excel spreadsheet with all the data and the graph on it for this, to get this graph. So it obviously has gone down again. But when we look at inflation adjusted house prices, okay, when we look at real house prices, so the inherent value of a house compared to everything else, right, that you're earning, or the value of everything else, as far as I'm concerned, we are in a crash, right? We have seen a major crash over the last 12, 18, 24 months. And the reason that's not manifested in nominal house price crashes is due to the very strong inflation we've had, and then that's led to the very strong wage growth and all the other factors we've talked about, has masked the fact that in real terms, house prices have fallen considerably in value. And I look at that, as a quite attractive entry point in terms of an inherent value of an asset, not just the nominal price tag on it. So my personal view is we have seen a crash. I'm going to do another video this week. I'm going to talk about this more. I'm going to talk about what happens next in 2024. And actually, just thinking about this, I've also, there's an 11th one. There's an 11th factor that I've not talked about here, which actually is affordability in terms of price earnings ratio of house prices. I wonder if we can just find that very quickly in here. Let's just go graphs. Let's see if we can find it very quickly. House price earnings by ratio. That looks like it might be quite a data heavy thing. I don't want to see 2023. I want to see a range. Somebody might need to help me if I can use all of this interesting data. Let's look at first time buyer house price earnings. Again, not fantastic. UK as a whole. But we can see, okay, look, this actually serves. This serves for me. Nationwide data, okay? Let's say this is point 11. This is house price earnings for first-time buyers. We can see that we were hitting almost 6 in Q2 2022, and we're down to almost 5. Almost 5 is the long-running average we've got since about 2014. So in terms of first-time buyers, the house price to earnings ratio has dropped fairly considerably, which is something we expected, and it's dropped considerably, even though house prices have not dropped considerably because of wage growth. Okay, so that's let's call that point 11. There we are, team. Give me a thumbs up if that was useful. I'm going to go through some questions now. That probably went on a little bit longer than I thought it would do. Thank you everybody for bearing with me. Teddy says refusing to accept new ideas is refusing to succeed. Totally agree. Stafford, I did get chased off. I'll put this to broadcast in 23 with a whole bunch of YouTubers shouting crash all the time. Prefer here with the numbers are assessed. Thank you, Stafford. Always a pleasure. By the way, people say, what do I think would create a crash? I do still believe if the economy falls off a cliff, we will see a crash. We could see peak to trough 30% nominal house price drops if we see a huge economic disaster. I personally think it's more likely that the only way we would see those sort of figures is a third or an external black swan event happening. The biggest thing to me is geopolitical risks outside of the UK. We've got Russia, we've got Ukraine, we've got Middle East. It's a tinderbox there that all has the potential to spill over into a horrible mess. We're not there at the moment, but it has the potential to. The economy is teetering along. It's limping along. I would say we're in technical recession, but it's not like we're seeing a massive recession with massive unemployment. Again, let's look back at the previous recessions. There really are reasons for them. 2008 was the credit crunch. That was a black swan event that came from the banking system. If you look at something that I'm going to put a video out this week again is actually the boom bust cycle, and how very often when we see massive boom, we then see huge bust. The thing is, we've not seen a massive boom I'm talking about economy here. Actually, I'm going to leave you with this thought. We've also not seen a massive boom in the housing market. Everybody says post-COVID, we've seen this huge boom. Let me show you this graph, because this will whetten your appetite for a discussion that I want to have this week about the boom bust cycle. If you look at this, inflation adjusted house prices, okay? From there to there is the post-COVID boom. That is not a boom in my book. That is not a boom at all, right? That to that is a boom. That to that is a boom. That's a little tick up. So we'll talk about that this week. Okay. Oh, no sound. Hopefully we've got some sound. Let's see, we've got some questions. Stafford, let's get the question on. Coming off fixed rate graph, 67 million in the UK, 33% on mortgages, say 22 million of those numbers are folk looking to come off compounded. They seemed high, so 22 million. So those numbers of folk coming off rate must be compounded. So let's just get that graph up, Stafford, so we know what we're talking about. So we're on the same page. You mean this graph here, is that the one you're talking about? Sorry, I'm moving your question around. 67 million in the UK, 33% on mortgages, say 22 million of those. I'll have to crunch those numbers. I don't actually know the answer to that, Stafford, in terms of, it is about, I think is it 33% of homeowners on mortgages? Is that right? I generally don't know those stats. I'll have to crunch those stats and get back to you. But these are not compounded. This is aggregate, if that makes sense. So it's cumulative. This is a cumulative figure. So we've got 7.5 million by the end of 2026. I did not answer your question at all there, I'm afraid, Stafford, because I don't know the answer to it. Let's see what else we got. John Doe, how you doing, John? Let's see what we've got to say. The rise in borrowing costs sheltered with longer mortgages and high wages definitely have kept prices stable. However, there's still a heavy burden on borrowing and still could force price down. Agree, totally agree, John. Absolutely. And I just want to clarify, I'm not saying here that I don't think prices will go down in 2024. I'm not saying I think they're going to surge up in 2024. I'm just purely looking at what's happened over the last 12 months and trying to make sense of the illogical. Because a lot of people come onto the channel and say things like, I don't get it. It doesn't make sense. We should be 20% down by now. We should be 25% down by now, 30% down. We should be in full-on market meltdown. These are the reasons why we are not. We could go into market meltdown this year. We could do, 100% we could. This is why I say I think long and shallow. I think we'll still have the pressure on, even if interest rates start getting cut, in May. Yes, that will have a perception, that will have a market sentiment, but I don't think people are stupid and are just going to go suddenly diving back in and over leveraging. I don't think the banks will let them, right? So I think there'll still be downwards pressure this year. John saying, I made as much money last year from bank savings as what I did from rent income. Yeah, and I think that's happening a lot, which is why, again, people are doing things like liquidating their equity-heavy investments now. A question I have, and this is something I started to think about today, is there is a narrative of a net outflow of landlords, okay? And I agree with that. Looking at the amount of units that are on the rental market is a supply-demand issue, but is that all because they're being sold? So yes, we are seeing a lot of stats with buy-to-let landlords exiting the market or a net buy-to-let outflow, so more people selling than buying. But I'm just wondering what data that is based on. Is that based on private buy-to-let landlords with buy-to-let mortgages? Because if it is, then we're missing a whole chunk of the borrower space or the investor space, which are limited companies with commercial mortgages. And I would be very interested to see the stats on that, about how many properties are being bought in limited companies with commercial products or in cash. And therefore, is the data capturing people who are buying in cash? Is it capturing, for example, the institutions that are buying up huge amounts of stuff? And if we want to talk about conspiracy, I would rather talk about, right, the likes of BlackRock, Lloyds, Barclays, all of these new institutional landlords who are probably coming in and buying huge chunks of new builds at cut prices right now to put into their build to rent, or sites where they're going to be building blocks of 300, 400, 500 flats on build to rent. This is where I think we should be focusing our attention, not on the retail side, but actually with this narrative that's happening. And again, if we go back to this graph, right, if I look at that as an investor and go, that's an interesting entry point, okay, into UK property. We are historically pretty cheap. If you draw it over, we're the same price, inflation adjusted, as we were in sort of 2002, 20 years ago. We're with the same inflation adjusted price as 20 years ago. right? Cycles generally have a habit of repeating at some point. If I was an institutional investor, right, if I had billions at my disposal, I'll be looking at this going, long term, 5, 10, 15, 20, 30, 40 years, we've got a great entry point to come in, hoover up a lot of stuff cheap, right, and hold it. And I'm not sure the stats of buy-to-let landlords exiting the market are being captured with all of this institutional stuff going on, or even likes of myself, right, with a limited company buying with commercial finance or cash. I do not know if the stats capture it. There we go. Interesting discussion to have. Tristan says, wow, 40-year mortgages. People never pay off their houses and the banks will inherit them. You'll own nothing. Very good point, Tristan. And effectively, what you're doing is probably paying an overinflated rent for a very long percentage of your living life to a bank. It's interesting. Jimmy, Rob, do you think prices will rise in 2024 if you had to bet? Oh, Jimmy, I can't say that because somebody will come back in 2025 and say, Rob, you bet. Maybe I'll put a $5 on it. Do you know what? If I had to put a $5 on it, I would say we're going to be slightly lower at the end of 2024. But saying that now, I just think the markets do contrary. And I would not, it all depends on how quickly the interest rates come down. If they do start coming down quickly in April, May time, I think we'll be up at the end of 2024. I think we'll have a pop. And let's not forget the fact we are election year. And Stafford, you asked, was it you, Stafford, who asked me last time about does election year affect housing market? And I looked into it, and generically, no, it doesn't really. So some people might sit on their hands until after the election. So generally, it does, but overall, it very rarely affects the property market. I think that could be very different this year, for the main reason that, as I said last week, a couple of weeks ago, the Tories will be wanting to effectively build their campaign on being the white knights that came in and saved the economy and got us through the cost of living crisis. To do that, they've got to get inflation down and they've got to get interest rates down. And they all want to get interest rates down as quickly as possible. Number one, for that election campaign. And number two, because they're servicing such a huge amount of debt at the moment, and also covering the losses on the bond selling program. So they'll want to get those interest rates down as quickly as possible. That could see, it could see a little pop of house prices by the end of this year. I don't know. $5, I don't mind particularly if we lose either way. So I'm going to go very slight reduction. Teddy says, I don't think you can apply TA to house prices. Yeah, no, I totally agree, Teddy. I do the TA with a very slight tongue-in-cheek, just looking at the trends rather than saying any sort of proper trading analysis. As you say, the lag is so big, nobody is sitting there trading. I'm just trying to look at patterns. It's just easier to sort of say that sort of stuff. There we go. Robin, as long as people have jobs and can access funds, they will prioritise somewhere to live. If economy crashes, they lose their jobs and house prices drop. 2008 crash, mortgages dried up. Yep, agree completely with you, Robin. Robert said, best case scenario for 2024. I think we've probably answered that. But probably not all. I'm assuming we don't want inflation. We don't want it. I think inflation and deflation both bring the same sort of issues to an economy. This is why we want steady growth, right? We want steady economic growth. We want steady inflation, about 2%. It's why 2% is the target, not 0% or minus 1%. 2%, we need some slight inflation to keep things going. So depending on whether the data is being fudged or not, we've got two scenarios. Number one is it's inherently sticky and we've got some systemic inflation that's going to keep it up at that sort of 4% for a while and keep interest rates where they are. The opposite is if it really is coming down as quickly as it is, I think there is a risk of deflation, and that could see interest rates come down much more quickly, which will change things very quickly. And again, look, if interest rates do come down quickly, we will inevitably see a big pop in asset prices. So the question is, will they? Will the inflation drop down? If the inflation drops down quickly, we go into recession, we'll go back into cutting interest rates and probably printing some money, at which point the asset prices will go up. There we go. Sorry, team. I've got to probably knock it on the head there. Hope that was interesting for you. Give me a final thumbs up if there was some useful info in that. I know we've been on for an hour. I'll probably have to do pre-recorded because my diary is fairly busy this week, and I'm running a webinar training on Wednesday, which I was going to do the next live. So I'll probably have to do a pre-recorded and put it out. We'll talk about real inflation-adjusted house prices. And if we actually have had a boom, and therefore will we have a bust, and is that another reason, a big macro reason why we haven't seen an implosion, is we've not actually had a massive boom, even though everybody thinks we have had a massive boom. I'm going to leave you on that thought. As always, it's been a pleasure. Enjoy your week, and I'll see you soon.